Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. We've got another great episode for you today. I'm really excited to have Andrew Moore on the show with us today. Andrew has about 8 years of real estate investing experience. He's got a cool story. He's former military, Marine Corps. And after getting out of the Marines, he was going to school, working a job, and ended up going on a mission to China and providing some missionary service. And upon returning from his missionary service in China, he got involved in real estate syndication. Commercial real estate. Prior to that, he had had some experience in the single family space, small scale multifamily space, but decided he was exposed to the world of commercial multifamily and the syndication model upon returning home and decided to dive headlong into that. He's got a cool story. He is a newer syndicator, a new lead sponsor who started by getting involved in a mastermind group, really learning how to underwrite deals, how to understand how commercial real estate works, how these deals are operated, and he was able to formulate some great partnerships early on to get involved in his first few deals. And then eventually he moved to a point where he felt like he could take on deals as a lead sponsor. He has since acquired 3 transactions as a lead sponsor, totaling roughly 600 units or so. And he also has 2 more deals under contract. We talk a little bit about some of the things he's learned early on in raising equity for these deals, how to formulate these partnerships, and also some insights into how he's navigating the 2 deals that he's got under contract with the new economy that we're in, with the challenges that we face from the potential recession and higher interest rates. And so really excited to share his journey with you and hope that you'll get some value from our conversation today. Without further ado, Mr. Andrew Moore. Mr. Andrew Moore, welcome to the show. Appreciate you coming on.
Absolutely. Thanks a lot, David.
So generally, I like to just get a little bit of a background on yourself. I've already told the listeners a little bit about you and sort of your background, but let's talk about that a little bit. What were you doing before real estate, and how did you get into the real estate world?
So that goes back quite a ways. Was in the military, and then started, as I transitioned out, started acquiring a few single family homes. After some time with residential rentals or single family rentals, I began learning about scaling with multifamily. A lot of folks would, suggested going bigger sooner rather than, waiting years and years. So I kind of took that advice and really started learning about multifamily syndications when our family was, we lived in China as Christian missionaries. And then it was kind of an abrupt transition when we moved back from China in 2020, right as fun things here in the U.S. were kicking off. I decided to jump into multifamily full time. Essentially, I didn't want to go get a job that I didn't want. Start working at something I wasn't really into. So I decided to sell my single family homes and sink or swim with multifamily. So we've been pretty aggressive. Learning to underwrite, analyzing markets, putting deals together and teams together. And I guess that's a bit of the history there.
That's great. Yeah, I appreciate that. I want to dive into a few pieces of that. I'm curious. So military background, what branch of the military were you in?
I was in the Marine Corps.
Okay, great. And how much time did you spend in the Marine Corps?
I went in as a lifer and then realized, 4 years was the right amount of time for me. So just did 4 years. Yeah.
Okay, great.
Really enjoyed it. Loved it. Great experience.
And when did you get out?
That was 2010.
2010. Okay, cool.
Yeah.
And then the Christian missionary thing in China. Wow. So first off, how does that even happen? Second off, what was it like living in China for how long were you there?
So we spent a year there kind of testing the waters, fell in love with the culture and the people, and just really felt like had a great opportunity there. Came back for a couple of years to go back long term. And then we spent about 3 years there. So about around 4 years total.
Okay, cool.
certainly when, we were teaching, I was studying Chinese for 2 years, and then I taught English for 2 years.
Got it.
Certainly provided some opportunities to build some pretty great relationships. So.
And so, did you, during your military experience, was there any connection to Asia or China?
No, none whatsoever. Yeah, things are a little bit, sensitive with with that line of work in that country. So, um, yeah, there was zero connection there. I think, traveling and my military experience kind of opened my eyes to international travel a little bit, and just, the ability to go and adapt and, adapt and overcome is, kind of thing we
Yeah.
say. So,
Yeah.
flexible, fluid, and we like to make things happen. So.
Okay. And so you'd mentioned some single family. It sounds like, just so I have, the sort of the timeline correct, there was some single family investing happening between your military experience and your missionary work in China. And
Mhm.
then when you got back from China, you went full on into multifamily. So maybe bridge the gap for me there. You got out of the military in 2010, and then yeah, help me fill in the gaps there.
Okay, sure. So, uh, transitioning from military to uh, a full-time college student was kind of interesting. I went to CSU for 1 semester, Colorado State University. Uh, Living in Loveland, married. I was 21, 22 with a bunch of 18-year-old freshmen. It wasn't a great fit for me, so I decided to go to University of Phoenix, uh, night school, or once a week in person, and then I drove and delivered plumbing supplies all across northern Colorado. So it was, you know, it was, I had a decent, full-time job with night school. I did that for a few years, and I, did well with that company, and had several different positions with them. Started at the bottom essentially, and liked what I did, liked the people. And during that time, I started trying to, understanding I needed to find other creative ways to make income. I think that it was interesting when I graduated. I had been receiving military benefits and a housing allowance, and then when I graduated, I actually took a pay cut because those benefits went away, and I just had the 9 to 5
Mm.
plumbing
Yeah, you got to love
supplies.
that. You graduate and take a pay cut. That's great.
Yeah, that's kind of interesting.
Okay, so 2010, you get out of the military, you're going to school, you're working, and then when did investing sort of, even sprout up in your world?
I think I think bigger pockets was certainly influential. In my learning there. I think my family and my family, my parents had instilled in me like the idea of saving up for something, and future goals, future outcomes for a little bit of discipline now. Um, so yeah, I was trying to buy duplexes and triplexes or a fourplex, with a VA loan in northern Colorado, with like a $40,000 a year income. Doesn't really happen,
Yeah,
as
doesn't work.
as you know. So I was trying to work every way I could to make that happen. Fortunately, I just bought homes. Appreciation was amazing in northern Colorado, kind of between the 2000, well, really 2010 to, I don't know if it stopped, but certainly those purchases provided me an opportunity to cash out and refi and acquire another property, another. So I was doing.
Okay, great.
Yeah.
And so what had you purchased prior to leaving to China?
I had two. I had two homes in northern Colorado, and while we were in China, I bought a fourplex in St. Louis.
Okay, cool.
Yeah.
And then you moved back. Did I hear what year did you move back from China?
That it was March of 2020.
Okay.
So
All right. Oh,
right
wow.
as right as right as things were locking down overseas, and then we got here for the lockdowns as well. So yeah.
And so I've got to dive into this. I know this isn't a podcast about that experience, but I'm curious, like, was it intentional exit out of China because of what was going on with the pandemic?
Yeah, great question. No, it really just lined up like that. I think I had changed our plane tickets a couple times, and it just so happened to fall right there. It had nothing to do with the pandemic. It just felt like the time was right for us to transition home.
Got it. Okay. So you moved back in 2020, and then what even causes you to start to think about commercial multifamily and syndication versus just continuing to do what you had already known in the single family or small multifamily space?
Really, it was just seeing how our net operating income determines our value, and not the neighbor's sale price of their residential home. Um, the idea of buying single family after single family after single family, and yeah, some people say, well, it's just as easy to close 20 doors or 100 doors as it is to close one door. First off, I don't agree with that, but I have heard people say that. It is a matter of like scaling or efficiency or the best use of our time to buy more doors at once. Yes, there's more work involved, but we have other people, attorneys and mortgage brokers and a team or a team of people to help us get that done.
So do you remember any particular instance where you were exposed to the world of commercial multifamily? Were you taking any type of training? Had you joined any mastermind groups? Like most people that are in the single family space or the small multifamily space don't make that transition without something happening in their lives to say, hey, you should probably go this direction versus staying in the small single family space.
There's definitely some big names out there. Michael Blanc, for one, was really, really influential. Put out a ton of content that really opened my eyes. Throughout me learning about multifamily through his content, I was introduced to Mark Kinney with Think Multifamily. So that essentially, the content that was out there on YouTube or online, paired with the timing of my transition back and my understanding and really commitment to making that happen, it was kind of the catalyst or the combination of things to help me hit the ground running when we got home.
Okay. And so from a professional and income perspective, you're a missionary. I don't know if you're getting paid for your missionary service out there or not, but help us understand sort of that process of coming back from a mission, what you were doing to earn income. Did you dive headlong into multifamily and that was your only source of income? What'd that look like?
Yeah. So it's funny. I talk with several doctors and surgeons, and they're wanting to get into multifamily, some of them full time. And I explained to them it's a little bit easier for a missionary to replace his annual income than theirs, essentially. So what we did was we sold our single family homes. We had some funds in the bank, and we decided to start living off of that savings to get into this full time.
Cool, love it. All right, so that is sort of leading up to your entry into multifamily space. I want to jump forward and talk about what your business looks like today. Maybe just describe how your business is structured, what you focus on, and what you're looking to do moving forward.
Yeah, so within the Think Multifamily group, I was able to find a business partner. Certainly, we do multifamily syndications, large, 100 to 300 unit acquisitions. So I found my business partner, George Klein, and then we partnered obviously with several other people in the group and outside the group to take down our deals. Right now we have 2 underwriters. So we've trained 2 people to help us with our deal flow. They do the first few levels of underwriting for us, and then we get in there with our creativity or our market knowledge and start kind of tweaking things as we see fit. That certainly helps us with the amount of deal flow. And then as we have built relationships with brokers, really in our markets, we know which ones we can kind of get aligned with a little bit easier, or some folks we need to take a little extra attention to see if we can get aligned or on the same page, or at least close. We have an executive administrator who keeps us focused and keeps us hitting our deadlines, or keeps our tasks getting accomplished.
Okay, great. And up to this point, maybe just describe for us your portfolio or what you've acquired since you got started in the multifamily space.
Yeah, so I believe it was May of 2021. George and I, we acquired our first property for ourselves. That was 274 units in Middle Georgia. Certainly like that market. Great properties have been performing really well for us. Um, for I think it's like about 4 months after that, we closed 256 units in Northwest Arkansas. That was a great newer vintage, great market, good team, and I think it's a $26 million purchase price. We raised about $9 million in a relatively short amount of time. Definitely helps us to understand the appetite for our investors in that market. Um, Shortly after that acquisition, just a couple months ago, we closed a deal in North Atlanta, in a nice little submarket, 104 units, another kind of large, it's $21 million acquisition. So
Okay, great.
yeah,
And you mainly focused on B, C class value add type product. What do you guys focus on?
yeah. So it's primarily B and C class. I think everyone is starting to transition away from older assets. They're wanting to look at 80s or newer, and I think as people progress and they begin to build a track record, they start wanting to look at a little bit more, little newer assets. I think that's where we're at. We're becoming a little bit more selective on where we're looking at deals too. We're not chasing shiny objects all over the southeast like we once did. I guess to backtrack a little bit, one of the reasons why we feel like we've been able to have this progress is because we partnered with other people on their deals. Essentially, syndication is a team sport, and to go out and expect a broker or investors to invest for a broker to sell you a deal and you've never performed or you've never done anything before. I think that's kind of a hard sell. And then to tell a bunch of investors, hey, I need to raise millions of dollars, and it starts with you. It's kind of hard. So we
Yeah,
suggest,
and you've
find
really leveraged. I'm assuming you've really leveraged the Think multifamily community to find those partnerships. Is that correct?
certainly. Yeah, absolutely. We are super grateful for our community and Mark with his partnership on all of our deals to this point.
So let's talk about getting your first deal under your belt. Just for
Sure.
those listeners that are wanting to go down a similar path, what did that look like for you? What was your role in your first deal? What obviously it sounds like you partnered with other individuals in the Think Multifamily program, and what was your role coming into that? What obviously it's a team sport. You can put these partnerships together, take down bigger assets, but everybody plays, generally speaking, a specific role. What was that like for you?
Yeah, absolutely. So as you're joining a group, like as you're joining a syndication as a general partner, you first off, you want to know that the underwriting's good. Like you don't want to just because there's people. I don't know, it's just important that you understand the underwriting and that you can communicate why it's a good deal to your investors. So uh, one was I was familiar with the underwriting. I found a lead sponsor that I trusted and I felt like I could work well with. And then I was primarily helping with capital raising, but we also like to kind of diversify and share some responsibilities in other areas of the deal as well. Um, yeah, so I had a goal. But I mean, my main kind of mountain to climb was to raise capital, and nobody really knows how that first deal is going to go until they put themselves out there. And I think that that's the fun part of your first couple deals, and it's why it's important to work with good people that you trust and are going to be gracious as you kind of take those first steps. But we've now kind of transitioned from being like that new raiser to certainly having more experience and leading our own deals. Now we get to kind of repay the favor, in some way. And obviously, it's obviously mutually beneficial, but that I don't know, something we get excited about.
Yeah, for sure. So what was that first experience like? You mentioned that, in addition to, being a part of the underwriting and the due diligence that you're, a big part of what you were supposed to do was bring some capital to the table. Had you
Yeah.
raised capital in the past for any other ventures, whether it be real estate or maybe your missionary service or something like that?
Yeah. So I think a little bit of this the sales piece, like we did support raising for, preparing to go to China. So we found and we got to communicate our mission uh, in that regard. And I guess transitioning back, I began to communicate to several folks that I knew were interested in real estate investing. I was explaining to them what I had planned to do. So I had two investors that I knew for sure would support me in my first deal. Um, I had a yeah, I think another thing, or I'm sorry, but something that I encourage first time like raisers, I guess, um, or to do is to join a solid deal, one that's not going to struggle to raise capital. Because if you don't meet your goal or your objective, you're not letting anybody down because the deal's going to fund it anyway. You know what I mean? Like if the deal funds quick, like no one's going to get mad that you didn't get all your guys in. So essentially that's really what happened to me. I had a goal. I think I did half of my goal, but the
What
deal
was your
funded.
goal?
So my goal was 250K. I
Okay.
raised 115.
From two
And
from two investors?
from two investors,
Okay.
exactly. Yeah,
So
yeah,
this is a great story, right? Because so many
yeah,
people think, oh, you just come into the business, you raise, a couple $1 million and you're off to the races.
yeah, yeah,
Here, this is someone that got started in the space, joined a mastermind group, had some connections, so he was able to be a part of a deal,
yeah.
and came in with a pretty low, expectation of what you were going to hit, and still hit below that, and but that didn't kill your career path in this
No,
space, right?
yeah, 100%. And that's the thing. So people stress and worry, and I just communicate to my team. I'm like, this is what our goal is going to be. Like, if you think you can do this, I want you to push and try to do twice that. But if something doesn't pan out the way you hope, it's okay. You know, like just do your best, and that's all we can really ask. And yeah, it's kind of interesting when people think about like multifamily syndication. They think that everyone's raising millions and millions and millions, and really it's a progression. Every deal or raise that I was involved with since then, that number is grown almost by 2x. Essentially, there's been a lot of progress. I'll just say in the
Yeah, that's
raising.
great.
raising yeah.
So, how many deals were you a part of where you were a co GP, weren't really leading the
Yeah.
project, but you were a co GP before you decided to take on a project as a lead sponsor?
Well, I started underwriting. I was trying to lead from the beginning,
Mm,
but rather than just hold on to my few investors and think, oh, I've got to save these guys for my deal. Um, really, like my heart is to grow capital or build wealth for my friends and family, and to kind of hold on to that for my deal isn't really serving them. So how can I how can it be win-win for everybody? And really, that was being involved, putting that capital to work into other people's deals. So I was a co-GP on 3 deals, and that was the time that it took us to find our first.
and with the first one that you let out on as a lead sponsor on, was that the 270 unit in Georgia?
Yep.
Okay, cool. Great.
Yeah.
And
Yeah. Yeah.
had you partnered up with George Klein at that point in time, or was it not more? Was he involved in that deal with you?
Yeah. So during those first few deals of co-GPing, that's when George and I started working together and analyzing deals. And then when it came to this deal, it kind of checked all the boxes. We called Mark and we're like, hey, this looks decent. We're flying out to go tour it. Uh, yeah, that was our first deal we started did
Okay.
together.
And what was that like taking on the lead of your first deal, the 270 unit in Georgia?
It's kind of funny. there's one guy we work with. He said, go ahead and strap in and prepare for the roller coaster. And then we started taking those first few steps and waiting for like the ride to start. And then sure enough, it started, and it's an emotional roller coaster. It's more than just, oh, I need to find a deal that pencils. You have to build a team. You have to do a ton of things that you spend all your training underwriting, and then all of a sudden you have to do a bunch of things that's you've never done before. So it's a lot of problem solving. Obviously, there's friends or colleagues, or folks in your network that can help you answer those questions. But it's stressful, and thank God we've had some progress. We've closed some deals because right now, I mean, we're working on a few deals that if I was doing these, a year ago, I would be stressed, out of my mind. But we've learned to get these, all of the intricacies accomplished. And I see other people working on their first deals right now, and they're stressed. I mean, it's a kind of a difficult environment right now for first time syndicators or first time leads to be doing deals, and it's just a matter of experience, I guess.
Yeah. So you acquired the 270 units in Georgia, roughly 270 units in Georgia. I think it was 274. 250 plus units in Arkansas, 104 units in Atlanta, and it sounds like you have a couple deals in the works currently.
Yeah, we have about 260 units.
Okay, great. And what markets are those?
We've got another deal in Middle Georgia.
Okay.
And then one in Little Rock. So
okay. And are you
yeah,
leading out on these, or are these deals that you're coming into as a co-GP?
these are deals I'm leading on. Yeah,
All right, great, cool.
yeah,
Well,
it's fun.
a few questions for you as we start to sort of wind down here a little bit is, moving forward into this sort of new economy, just for the listeners' sake, we're recording this end of July. We're a few days out from another Fed meeting that could ultimately have a pretty big impact on interest rates yet again. And so there's a lot of uncertainty in the market. I believe that that many operators and sponsors that are taking down deals are starting to struggle to raise the capital that they need to get these deals closed. I've seen, it wasn't uncommon for all the deals that come through the pipeline to see, hey, oversubscribed 24 hours, fully funded 48 hours. And now we're starting to see deals that get pushed out. And then, a week later, it's, hey, we still have a little bit of room. A week later, so there's a sense of, hey, there's a lot of capital that was looking for a place, but with all the uncertainty in the market, the economy as a whole, talk of recession, there's a lot of investors that are just sort of, maybe sitting on the sidelines a little bit, waiting to see what happens. What's your experience been like in as far as that is concerned?
Um, there's I think a lot of parts to that. I think there's several folks that are more cautious and they're sitting in the sidelines, or they got beat up pretty bad in the stock market, so they don't want to sell any of their stocks to transition into multifamily. That's the case with a handful of my investors. I think that there's been a lot of deals, so a lot of within my some of my colleagues networks, like their funds are already in deals. Fortunately, those deals are exiting, and there's going to be more capital to redeploy. I'm pretty bullish overall on the on interest rates and on the economy. I understand they're gonna hit a peak, and I think they're gonna start coming down. Yeah, so I don't know.
Fair enough.
That doesn't answer your question very well. But
My question was, go ahead.
I've certainly experienced it. Capital is a little bit slower these days. Absolutely.
Yeah. Okay. Fair enough. So, what has changed in regard to your underwriting? It seems like you emphasize at least your role in these deals is a big part on the front end on the underwriting of the deal. What has changed in regard to your underwriting as interest rates have, started to climb, and things are changing.
Well, I'm seeing like projected returns, like IRRs are coming down, or people are offering deals with lower IRRs or less cash on cash. Um, um, we make a habit to really to be ultra conservative. Like I, I know it's a buzzword to say conservative, right? But we want to be really careful to not overpromise and underdeliver. So we under we I think we have a pretty good record of under promising and over delivering. But then when it comes down to getting the financing we need from the banks, they're like, your underwriting is too conservative, right? So it's like almost like you need two different types of underwriting for who you're presenting to. But we're considering, we typically offered an 8% preferred return. We're thinking about scaling that back to 6 or 7. Maybe offering a deal with a 90% total, an 80 or 90% total return. We're just being more selective on the deals that we pursue. We don't need to pursue one. Another thing is picking a better market. Like if your returns are just average, don't pick in a tertiary market. Stick to some of the more popular places.
And with the deals that you're currently working on, I believe you mentioned you have 2 under contract. What kind of debt terms are you seeing on those deals?
Yeah, so it was right as the debt market was starting to change last year. In Georgia, we were getting 80. Everyone was getting like 80% bridge loans, but we scaled back our underwriting from the beginning. We were underwriting 70%. So that's still where we're at. I think we've heard of like people's funding still getting cut shorter than that. But I think we're at 72% on our current deal, and then we've been modeling 70 on our Little Rock deal. So I think we're at a pretty decent spot with that. We'll see where the actual rate shakes out. But
and is that floating debt?
It is, yeah, yeah.
And what are the terms on that? I mean, just roughly, curious. Are you buying a cap on the rate, or yeah, go ahead.
We do buy rate caps, and yes, they're very expensive right now, but they beat us up a little bit. But yeah.
Yeah. Okay. So, how far out are you on those deals? Are they getting close to closing?
One's one's a month out, and another one is still about 2 months out. So things are progressing well. Yeah.
Anything that you've learned in doing a deal right now in all this uncertainty that you could share with our listeners that might be helpful to them if they're about to go under contract on a deal?
Yeah, I would say there's several different like groups out there that where you could find a deal and build a team really relatively easily, right? As you said, deals were getting funded in 24 hours or whatever. So I would just go in really strong, knowing who your partners are going to be before you even fly out to tour, or before you submit an LOI. Know who your people are going to be, so you can move quickly once it's under contract. Some people might think, well, that's a no-brainer, but there's groups out there that you can assemble the team once you have the deal. You know what I'm saying, David?
I'm not sure that I'm following you. So, are you suggesting that? I mean, it seems pretty obvious that you would put your team together, or at least you'd have a sense of who your team is. Are you suggesting that, hey, you want to really formalize a group before you actually even are offering on a property? Maybe go through that.
I guess just have a good understanding of what that team's going to be and their ability to actually deliver. I mean, there was, so I'll share one thing. We had a team built, and one guy said he was going to do X, and then like 2 weeks later, he went out and got his own deal, and he couldn't meet kind of the expectation that we had already pre-discussed. So it's just those kind of nuances, like know what you're at, have those boxes checked, or make sure.
And are you mainly, so it sounds like that's coming from that experience. Like here, you thought you had a team together. Yeah. You are really looking at it from a perspective, what's my capacity to raise the equity needed to be able to close on the deal, right? And there's a lot of moving parts as your debt terms change, that can have an impact on how much equity you need to bring to the table. You may have
Yeah.
a partner that exits
Yeah.
and can't participate for one reason or another.
Yeah.
And so that's always the big question mark, right? Can we raise the equity needed to be able to get this deal across the finish line? So what you're
Yeah.
suggesting is really work hard on the front end to
Yeah.
formalize a team, get stronger commitments, more than maybe just a loose commitment of individuals that are going to be coming to the deal and participating in the deal and being able to bring equity to the deal as well.
Yeah. Yeah. Well said. Thanks.
Okay, great. Anything else you've learned in your experience on these deals that would be helpful to our listeners as they're navigating this new terrain and new economy that we're in right now?
Um, I think one, just be really mindful of who you're partnering with and who you're working with, and then the number two is, or maybe it's the number one, but just get started, start taking those steps. I think that so many people sit on the sidelines thinking about now's not the right time, or over analyzing things. We can all find a way to make a deal not work, a partnership not work, but it's going to take a step. It's going to take an action, and I'd rather I guess fail forward. I guess some people say that. So get after it.
Yeah, fair enough. All right, a couple of final questions for you. The first one is, what's the biggest challenge that you're facing right now in your business that we could all learn from?
Well, I don't know if you can learn from it, but it's scaling. It's essentially what all businesses and entrepreneurs challenge that they face. It's a matter of working. We need to work on the business instead of in the business so much. So we're really in the process of hiring a couple different people right now to help us with marketing or with some bookkeeping, that kind of thing. So something to keep in mind or plan for.
Yeah, for sure. And last question for you. What's the best way for our listeners to connect with you and learn more about what you have going on?
Yeah, so we are actually just now launching a new website. It's called ardentequitygroup.com. That's Ardent Equity Group. My email is andrew@ardentequitygroup.com. Formerly been kind of marketing as Hill Creek Capital, but making that transition right now.
Cool. That's great. So that's ardentequitygroup.com, ARDENT equitygroup.com. We'll have that link into the show notes so you can go down in the show notes and connect with Andrew. Andrew, thanks for jumping on the call with us today, sharing a little bit about your journey and your background, how you got started in the multifamily space, and a little bit about your business and some strategies that you're deploying in the new economy that we're in today. Thank you for coming on and sharing with us, and I look forward to connecting with you down the road.
Awesome. Thanks a lot, David. It's good chatting with you.